much. Hi, everybody. This is Roger Strode. I'm a partner with Foley and Lardner in our Chicago office. I want to thank everyone for coming to what's now the fourth installment of this year's Access to Capital webinar series. We're really excited about this series. It's really been terrific. We've had great feedback, and we've had an awful lot of folks that have attended these webinar series. Today is our fourth and final installment for 2013, and as you might guess, an installment like this, we like to use it to look back at what happened in 2013. But from the standpoint that past is prologue, what we like to do is not only look back at 2013, but we want to give everybody a look into 2014 and possibly beyond, given the robust activity that we've seen in healthcare M&A this past year, both healthcare M&A as well as healthcare financing and overall healthcare transactions. Joining me today, we have a terrific panel, and I'm very excited about the folks that are joining us today. The first is we've got a very special guest speaker. We have Mike Quinn from Ziegler. Mike and Ziegler are good friends of Foley and Lardner, and Mike's background, after spending more than a decade in bond insurance, where he most recently ran Assured Guaranty's healthcare underwriting group, Mr. Quinn moved over to the dark side of investment banking, and he's currently a director in Ziegler's healthcare finance practice. Mike sources capital and provides strategic advice for his not-for-profit healthcare clients. Joining Mike and me today are two of my partners. First is Heidi Jeffrey. Heidi and I do a lot of work together, and she's a partner in our Chicago office and services our public finance and healthcare finance practice clients. She regularly serves as corporate counsel and underwriters counsel for both healthcare and general municipal financings. And then joining Heidi and Mike and I is David Bannard. David's resident in our Boston office, and he's also a partner in the public finance and healthcare finance practices. And he serves as both bond borrower, well, not both, but bond borrower and underwriters counsel for both healthcare, for all of healthcare, airport finance, and energy financing. As I mentioned, what we're going to do today is we're going to break this up into three chunks, followed by a Q&A session. What we're going to try to do is look back at 2013 and look at both regulatory activity, look at 2013 regulatory activity, and what does that mean for 2014 and beyond. And then we're going to look at both deal and financing activity in 2013, and again, use that as kind of a microscope to look at what Mike's going to fill us in on what he and his colleagues think that we're going to see in 2014 and beyond. Then I'm going to moderate a little bit of a group discussion between Mike, Heidi, and David to talk a little bit about some of the trends that we've seen and some questions that we know that are out there generally we think that you have. And then finally, we're going to talk about and we're going to open it up to Q&A. And I think we're going to actually open the line up as well as you'll be able to type in questions on the website. Before we start, a couple of housekeeping things. The program's going to run for an hour and a half, and we're going to apply for 1.5 general CLE credits for today's program. All New York, New Jersey, and Kansas attendees who are applying for CLE have to fill out an attorney affirmation form, which you'll see on the site, and write down the course code that's going to be given sometime during today's web conference, and I will give that to you later in the conference. Again, you can find that form and the slides in the materials section of the screen, on your screen there. Plus, electronic questions can be submitted during the conference by going to the Q&A tab on the screen. To start us off and get us started here real quick, I just want to give everybody a little insight as to what we've seen in 2013 in terms of overall deal activity, and really start that by talking about some of the drivers that we've seen. If you could, I want to advance the slide here. Actually, operator, could you advance the slide for me? There we go. Some of the drivers that we think we're seeing with the M&A activity that's out there, both hospital, physician, I should say facility, physician, services activity, which we see a lot of. There are probably about four drivers I'd like to touch on quickly. One of them is access to capital, strengthening capital, and probably also strengthening bottom lines. We are seeing a lot of people out there with this sort of too big to fail strategy. We think doctors still feel like they need shelter, generally with large hospital systems or bigger physician groups. And smaller hospitals we're seeing need capital partners. And finally, we're seeing bigger hospitals and even publicly traded deals coming together because of that sort of geographic coverage, geographic scope. People need capital, we think, for electronic medical record, decision support tools, and it just makes them relevant to the market. It makes them relevant to payers, makes them relevant to physicians. The other is scale. The second is scale. Increased service and geography offerings we're seeing people going for with these larger transactions, and we're also seeing broader continuum of care transactions going on where we see them filling in gaps in sort of pre-admit and post-discharge services when you're talking about hospitals, picking up home health, long-term care, rehab facilities. A third driver we see is a need to measure healthcare outcomes. A lot of providers are trying to be responsible to these new payment models. And as a result, they're looking for doctors and clinicians that can better manage care than those that they have. And they're also, we see healthcare systems, physician groups, insurers buying technologies to help manage care that are out there. Payer and provider combinations are a really good example of what we're seeing. And then finally, we think that consumerism is driving some of this healthcare consolidation because, frankly, we're seeing people take larger risk retention on their own health insurance with, higher deductibles and taking higher risk insurance policies. So we think those are drivers that we believe we're going to see going on into 2014 as well as into 2015. Just real briefly, I wanted to talk about a few of the deals that were out there this year that are pretty notable, and you'll see some of them on the screen here. If you look at some of the publicly traded company deals that went on, I mean, there were some real game changer deals. The Community Health Systems HMA combination, the $7.6 billion healthcare services deal, $3.9 billion in cash and an assumption of about $3.7 billion in debt. As a result now, Community Health System, I think it's safe to say they have more hospitals than any other healthcare system in the country. I believe the combination gave them 206 hospitals in 29 states and almost $19 billion in combined revenue. Then that deal closes, I believe, early 2014. At least it's slated to close early 2014. Then you have the Tenet Vanguard deal. That was $1.8 billion in cash and roughly $2.5 billion in debt for a $4.3 billion deal. The combined entity now has 77 hospitals, 173 ASCs and other facilities, 5 health plans, and 6 ACOs, and it has given Tenet and it's given that combined entity access to markets they didn't have. For example, Michigan's a great example. On the not-for-profit side, if you want to talk about large deals, probably the most notable large deal that was out there this year was the Trinity CHE combination and merger. That entity now, that makes it the third largest Catholic healthcare system in the country behind CHI and Ascension. The combined entity now has 80 hospitals covering 20 states with $13 billion in revenue and over $20 billion in assets. It's a massive organization. And then in some interesting market-by-market deals that we've seen that are going on and have been completed, Chicago, our hometown for Heidi and I, Chicago has seen an awful lot of activity. If you look at Edward Hospital and Elmhurst combining, that created a 3-hospital system that covers a large chunk of DuPage County. It's made that system very, very relevant to payers and made it a real competitor to the Cadence system as well as to Advocate. It's now an organization with over $1.5 billion in revenue, as well as an affiliated managed care organization called Illinois Health Partners. Speaking of Cadence, of course, completed its acquisition of Sherman Hospital, and that came on the heels of its acquisition of Delnor several years ago. And now Cadence, as many of you know, has signed a letter of intent to acquire Rockford Health System. In another market where we've seen a lot of activity is Arizona. Scottsdale Healthcare just completed its affiliation with John C. Lincoln Health Network, making it the second largest system in Arizona behind Banner. That is now a 5-hospital system with over $1.5 billion of revenue and over 200 employed physicians. So we're seeing an awful lot of activity out there, especially in healthcare services. And then finally, and I thought this would be interesting out there, a couple of statistics that I thought people would find very interesting. If you look at Q3 year over year, the third quarter of Q3, year over year, there are 267 reported deals in all sectors of Q3, 16 physician medical group deals, which is up 166% over Q3 of 2012, 24 hospital deals up 33% over Q3 of 2012. And when you look at if the venture and the private equity markets are something that interest you and you find them to be proxies of the bigger market, there were quite a number of large venture and PE-backed services deals with average exit values of over $359 million. And that $359 million is about an 8.5% multiple on trailing 12 months earnings and a 7.5% multiple on invested capital. And if you compare that to device and biotech, those multiples on trailing 12 months earnings were in the 6 and the 5 range, 6.03 for device and 5.12 for biotech. So that gives you just some sense of the level of the robust activity that continues to go on in healthcare M&A, especially on the services side. Now I'm going to turn it over for the next 20 or 25 minutes to my partners, Dave, Bannard, and Heidi. Dave and Heidi are going to kind of give us a glimpse into the regulatory environment this past year and what that's going to mean for 2014. So David, Heidi, it's all yours.
Great. Thanks, Roger. As Roger mentioned, I'm now going to turn to some of the key regulatory initiatives that we saw in 2013, and starting with a much more active SEC. As many of you know, there was heightened scrutiny by the SEC in the municipal securities market in 2013, and as a result, there were several interesting settlements. The actions that seemed to grab headlines were those related to the state of Illinois, Harrisburg, West Clark, Indiana, South Miami, Miami, and Greater Wenatchee. I'll get to the lessons and what we think will be a continued theme in 2014 in the next slide. But sticking with the 2013 settlement, I think we saw several common settlement requirements. In 2013, the SEC seemed to indicate throughout these settlements that the important considerations centered around the adoption of written policies and procedures regarding disclosure, the designation of one or more, staff officials or team members responsible for disclosure, providing regular training for staff involved with disclosure, and also a more increased engagement by outside professionals in helping with disclosure. And looking ahead to 2014, we certainly anticipate continued SEC scrutiny of the municipal market. I think it's safe to say at this point many of the initiatives in 2013 were centered around municipal issuers, but I guess, talking internally with the Foley team, I'm not certain we see any reason why that wouldn't continue to evolve and potentially take a greater scrutiny of some of the non-municipal, or in other words, conduit transactions. So moving on to the next slide, and looking ahead to 2014, and again, because we do anticipate in 2014 continued SEC scrutiny of the market, municipal market, we're really encouraging our clients to note some of the key lessons learned in 2013 and to develop 2014 work plans around some of these lessons. So again, turning briefly to those key lessons to take note of and considerations for implementing in 2014. I guess, again, I turn back to written policies and procedures. Those certainly seem to matter to the SEC, and we've been working with clients on their securities disclosure policies and procedures. And this has come up in a couple of contexts. One, both because we're seeing investment banking firms take a much more aggressive look and a more serious responsibility towards underwriting in the context of 15C212. So as a result of past 15C212 violations, we're seeing almost as a condition to underwriting the implementation of policies and procedures, at least as it relates to ensuring timely compliance with 15C212. And of course, the other big driver for policies and procedures is, again, in reaction to, I think, those 6 settlements that I noted in the earlier slide. So again, considerations for 2014, more focus on written policies and procedures. I think pension disclosure for municipal issuers and frankly for our conduit clients, that'll continue to remain a focus of SEC scrutiny. As noted earlier, compliance with continuing disclosure requirements is absolutely crucial. This was noted certainly in Harrisburg and in West Clark, but also just in terms of doing deals on a day-to-day basis, whether we're serving as underwriters counsel, where we're seeing our banking clients give specific directives to document and more carefully review continuing disclosure requirements, both as it relates to quarterly and annual filings, but certainly as it relates to the filing of material events notices. So compliance with continuing disclosure is absolutely crucial. And it's certainly clear that underwriters are feeling the heat, both from the SEC, but also we're hearing more and more from FINRA as it relates to diligence surrounding prior disclosure requirements. So for our borrower clients that are on the line and listening, as it relates to 2014 and kind of work plans related to security matters, certainly a focus on continuing disclosure compliance is key, both because the SEC has said so, but also, practically speaking, because many bankers, I think, are seeing FINRA also take a much more active and aggressive posture towards underwriters and the diligence that they're doing. So again, this will be something that borrowers and issues will continue to hear about during deals. Another key implementation for 2014 is to take a look at website disclosure. I think as we saw in the Harrisburg matter, when you quote-unquote speak to the market, this can take many forms, including website postings. And so doing a review in 2014 of how you're speaking to the market, how you're using websites, I think that's an important strategy and something to build into any work plan for 2014. I think in 2014, we'll continue to see the SEC focused on how compliance with tax requirements, how that can play into material information disclosure. And of course, we saw that in the South Miami settlement. Again, lessons for implementation in 2014, doing due diligence with regard to compliance with continuing disclosure obligations. I just touched on this, and I cannot emphasize enough, both as it relates to deals that we're presently doing, but also just talking to folks in the industry. Investment banks are absolutely feeling the heat as it relates to continuing disclosure. We expect that this will be felt very acutely by our issuer clients and our borrower clients. And so understanding and perhaps getting in front of that to kind of clean up your own house and performing, diligence related to your particular compliance program around continuing disclosure. We think that also would be a prudent step for 2014. Another lesson, failure to comply with accounting standards and practices can potentially lead to misleading disclosure. And then, of course, not rushing to close, not taking shortcuts. I think this goes without saying, but we certainly saw it both as it relates to the Wenatchee matter, but also I think kind of as an ancillary matter in the Illinois settlement. I think that the SEC is also encouraging a new approach to doing deals, and so taking time, revisiting both documents, making sure that transactions are done in a meaningful way, and kind of challenging past precedent of doing deals and reliance on documents. I think those are all things that we'll continue to hear discussed in 2014. Dave, do you want to take us through another regulatory initiative for 2014, the Municipal Advisor Rule?
Certainly. So this clearly is another area where the SEC has been active, although there are those who would say active is sort of in the eye of the beholder. The initial proposed rule was issued in September of 2010. The SEC received over 1,000 comment letters, and in their desire to respond to them, issued a 330-odd page rule, at least if you look at the Federal Register. The initial publication was 777 pages. So for those who have waded all the way through, congratulations. We'll try to give you a quick distillation and wet your whistle on this. As many of you know, the Dodd-Frank Act included a requirement that municipal advisors be registered with the SEC. And the SEC has been wrestling with how to do this, but really, most importantly, with the concept of who is a municipal advisor. And so this rule, the real key to the rule is not the registration requirements, but are the definitions of who is and who is not a municipal advisor and the situations in which this rule will pertain. One of the key issues is that by statute, municipal advisors have a fiduciary duty to their clients. And so that raises the standard for the advice that they're giving. The definition is taken pretty much from the Dodd-Frank Act, and then is explained in some painful detail in the discussion. But a municipal advisor, in essence, provides advice to either a municipal entity or an obligated person, and the obligated person would be the ultimate obligor under a municipal security. So in a conduit borrowing for a healthcare healthcare obligor, that would be the healthcare borrower. And it's with respect to municipal financial products such as guaranteed investment contracts, swaps, and the like, or with respect to the issuance of municipal securities. So one of the big carve-outs, and one that we keep trying to think through, is if you're getting advice as an obligated person or a municipal entity from someone, but it's not related to either municipal financial products or the issuance of municipal securities, that is not something that's going to be regulated here. And that's, again, something that is going to play out over time. Lastly, municipal advisor is someone who undertakes a solicitation, and I think that's probably more straightforward. That's where you're basically pitching a third party for consideration. I think a couple things that it's really important to note on this is that this rule is going to affect all the participants in the municipal deal-making world, not just the financial advisors and municipal swap advisors and other muni advisors, but it will have a significant impact on underwriters and may make it very difficult or chill the kinds of calls that many good investment bankers will make on both past and present clients as well as potential clients, where they keep a run of the bonds that are outstanding, monitor potential refundings and the like. And we've seen that having spent 12 years in-house at a large issuer, it was incredibly helpful to have that kind of forward-thinking advice that was provided. And there are many of us that are afraid that this may have a chilling effect on that market. So it's something that if you're an issuer, if you're an underwriter, if you're an attorney, if you're an accountant, all of these professions are affected by this rule. And unfortunately, it's designed to address abuses by a few persons and entities that have affected the municipal market, and the SEC and Dodd-Frank are trying to address that. So the real key here are the exceptions. The SEC has made it clear that what they're trying to do is accept both activities and parties acting within certain scopes. But really the exceptions evidence a couple of views that I think are somewhat unrealistic. One is the exceptions are, when you look at the exceptions for roles, they sort of unduly compartmentalize how a transaction will work. So an underwriter serving within the scope of the underwriting, that's fine, but if an underwriter is providing advice with respect to some other aspect, so for example, if a deal is being done that's a variable rate deal and the issuer or the obligor asks the underwriter about creating a synthetic fixed rate product with a swap, the underwriter is, unless an exception is met, is barred from providing that kind of advice. Another example that I'm rather familiar with is when the working group meets around the table, you'll have all the representatives, and typically besides the issuer, you'll see a financial advisor, you'll see one or more investment bankers, there'll be counsel there for various parties, and often you have quite a few years of experience, and all of those people have insight into ways that a deal can be refined and structured in order to make it work in the way that the issuer is really trying to see it work. There is some fear that that kind of discussion may well be chilled because of this rule. So we will be doing a webinar on this subject in February. We're going to try to dig into practical ways to deal with the rule for the various parties involved, as well as practical implications. So stay tuned, and if you've got questions, please do reach out to us. We think this is going to be a really big deal in the market in the years to come. Heidi, you may want to pick up on some of the recent tax law issues that are going to be impacting folks.
Great. Yeah, and no regulatory review, of course, is complete without a discussion about what the service is doing. I'll briefly discuss the emphasis on 501R requirements. There seemed to be great emphasis in 2013 around 501R, which of course indicates that hospitals must establish procedures to comply with the requirements of Section 501R. There were proposed regulations issued in April of 2013, and as I think most of us know, Form 990 was revised to include 501R requirements, and I also think, just speaking practically, in many of the deals that we were involved with in 2013, I think we saw an increase in activity, diligence activity certainly, focused on 501R, certainly both in questionnaires, but also in terms of review of websites to make sure that assessment reports were available and posted, but also just an increased emphasis in conversations, management interviews around 501R readiness, as well as compliance with 501R. So that certainly seemed to be one of the key IRS initiatives in 2013. But in terms of what we're seeing for 2014, and gosh, we could devote a whole webinar on tax matters as well as, the IRS work plans and key initiatives. But in terms of what we wanted to cover today and what we're seeing in 2014, one of the things that I think will become of much more emphasis, and we're already starting to see this in some of the deals that we've been working in, and honestly, we raise it because many of our listeners and participants today are either issuers or borrowers. We want to raise this just so that, for your familiarity and to provide greater sensitivity around this issue. But we anticipate in 2014 that there will be continued discussion around the issue price rule. The proposed rule could significantly affect current practices concerning the determination of issue price. And this typically manifests itself in closing certificates provided by the underwriters. But we also think it could have the effect of changing how deals are underwritten. And we raise this point, as I said, more as a point of sensitivity for our borrower and issuer clients that no doubt will be hearing a lot of discussion about this among bond counsel and the investment bankers during document sessions. There are a variety of reasons why issued price is important, but it's certainly important because it helps determine several key factors, both as it relates to the sizing of any debt service reserve fund, but also sizing of cost of issuance. And it also is useful in determining whether credit enhancement is cost effective and therefore capitalizable. So we're seeing the issue price rule creep into deal discussions already, even though at this point it's proposed. But again, we anticipate in 2014 that this will be of continued interest for many participants involved in a deal. Dave, antitrust?
Yeah, I'll just add on to the end of that is that the issue price rule is part of some proposed regulations issued by the service this past year, and I think it makes sense for market participants to weigh in on that and to monitor it closely. There's certainly been a lot of commentary already about the potentially adverse impacts of that rule, and the comments to the service are really important, and it's an opportunity to have an impact on this, because there could be some real problems going forward. On the antitrust review, on the antitrust review, we just wanted to touch briefly on this. It's not so much new at the federal level as it is an ongoing issue, but because there's been so much M&A and other affiliation joint work activity, it's important to bear this in mind for healthcare providers that are positioning themselves for some sort of combination. It's getting increased scrutiny. Both FTC and the Department of Justice have made this a focus. And here in Massachusetts, we've seen as a follow-on to the Massachusetts experiment with universal health care, that there is a relatively new board that is tasked with trying to keep the average escalation of healthcare costs in check, and one of the things that they have been doing is giving very close scrutiny to the potential pricing impacts of combinations. And Mike Quinn and I have talked about this a number of times. We are seeing deals that are being slowed down significantly here in Massachusetts because of that scrutiny, and I think it's safe to say that it may also result in certain kinds of required undertakings by participants in these matters. So one of the things to look for in the year to come is both at the federal and at state levels that using these antitrust or cost containment reviews of combinations. as I think everybody knows by now, the healthcare and hospital combinations are subject to scrutiny and enforcement, and it doesn't matter if you're a for-profit or a not-for-profit. And in a fairly interesting case, recent case, two municipal hospitals in Georgia sought to combine, and the U.S. Supreme Court held that they were not protected by the state action doctrine. So even if it's a municipal entity, that may not be the shield. So we toss that out as a kind of word to the wise who are thinking about affiliating. This is an important matter to keep in mind from the early stages in terms of the way you go about thinking about it, the kinds of merger partners, and very importantly, the way you document your deals. Because one of the things that will happen in a review by FTC or Department of Justice is they will look to see all kinds of written records and sometimes a honest but somewhat blunt assessment can really cause problems down the road. So that's probably enough on that. Turn it back to Roger and to Mike to kind of look at where Ziegler sees things going in the year to come.
Thanks, David. One point on the antitrust piece. What we're counseling clients in many situations is we expect that the FTC has been really emboldened by the victories that they've had and the abilities that they've had to either slow down and or stop combinations. If you look at what happened in Rockford with OSF in Rockford, if you look at Toledo with ProMedica, St. Luke's, if you look at what's happened down in Georgia, we believe that the FTC will continue to push on combinations that they think are anti-competitive. And from this, there's probably three things you want to think about real quickly is, David mentioned it, it's your 4C documentation. You've got to be very, very careful that if you do have to file Hart-Scott, that things like strategic plans, documents, notes, pieces of paper, et cetera, that say anything about market shares, market strategies, combinations, et cetera, are likely to be disclosable to the FTC in a Hart-Scott-Rodino review. The second thing to be aware of is if you think you have a combination that is going to have some impact on either a hospital or a physician market, and many of these hospital combinations, by the way, are causing the FTC and the Department of Justice to poke their head up and look at whether or not combinations of hospitals are also affecting combinations of physicians. If you think that you're going to have market control issues, getting an independent and probably an attorney-client privileged study by a nationally recognized economic firm is probably a pretty good idea. And then third, carefully consider whether or not a deal can be structured in a way that you don't have to file Hart-Scott. Some people like to file Hart-Scott even if they don't have to. They sort of think it's this get-out-of-jail-free card. I tend to be of the opinion that you never ask the government a question to which you do not already know the answer. But there are many combinations that are being structured around not-for-profit hospital affiliations that do not require Hart-Scott. That being said, understand that the fact that you don't have to file Hart-Scott doesn't mean that your transaction wouldn't be scrutinized. With that, we'd like to turn it over now to Mike Quinn at Ziegler. Mike's going to give us a look at the M&A and the financing activity that went on in 2013 and what we expect to see in 2014. Mike, take it away.
Absolutely, and thank you, Roger. It's great to be with the team from Foley, and just want to say thanks to all the attendees for taking time out of your busy schedule and allowing us to share some perspective here today. I think what we'll do is we'll go through a review from the perspective of capital markets and end from strategy for 2013. I think we can move briskly through those slides, and then we'll focus on our outlook for 2014, both from a capital markets perspective and from a strategic perspective. I saw one of the questions come over the webinar, and someone asked if the presentation would be printed out. And immediately I had some fear there. I make some pretty specific prognostications for 14, and I'm concerned that many of those may be used against me with some some history behind it. So we'll see how that goes. But in some respects, I think there is some very important analogies between what healthcare is facing as a sector and what banking/capital markets is facing as a sector. The folks at Foley spent a lot of time talking about government regulation and the implications of that. And, obviously for healthcare, I think the sector is also struggling. Obviously, we have the rollout of the ACA. By anybody's estimation, that has been fairly rocky. There is news each and every day, whether it's the delay of the employer mandate, whether it's policy cancellations, as it's being very clear that not all insured lives can keep their policies. On the governmental reimbursement side, it seems like it's death by 1,000 cuts, lower market basket updates. Providers are struggling with sequestration. So in many respects, very disruptive environment. Same holds true from our vantage point for banking. This is a year where we're struggling with Dodd-Frank. Foley did a nice job of talking about the muni-specific regulations. You've got the Volcker rule slowly becoming final. You've got a whole host of considerations, overhang of the LIBOR manipulation rate scandal. We're also dealing with a lot of unknowns. So in many respects, a transitional year, both in healthcare and in capital markets. And it is very, very difficult with this sort of disruptive change to do capital planning. Let's just start with an overview of the market. We started out this year with fixed income rates at or near their all-time lows. We've seen those lurch forward pretty significantly starting in late April. You can see here that the 10-year Treasury is currently in the 286 range. By the consensus estimates, we are looking at rising rates through the 2014 calendar year. We do think inflation will stay in check. Unemployment is still unacceptably high, but slowly as the economy recovers, it is starting to trend down. The municipal market used to be highly correlated to the Treasury market, but what we're seeing now over the course of the last few years is really a market that's become more supply, demand, dynamic focused. We're paying a lot of attention to fund outflows. We began 2013 on the heels of significant fund inflows into the tax-exempt bond market. In 48 out of 52 weeks, we saw fund inflows. Fast forward to the last 28 weeks, and we've seen fund outflows in each and every week. You can see that depicted in the right quartile. They total about $54 billion over the course of that 28 weeks. So, we've really seen the market lurch forward. It's not just supply and demand, however. We talked about government regulation. We obviously have QE3, an unprecedented stimulus program out there managed by the Fed. In late April, Fed made some comments about tapering QE3. We saw the market jump up by about 100 basis points. So very, very volatile environment, hard to plan for economic refundings, hard to get a handle on your cost of capital when you're planning for new capital. We've seen short-term rates stay persistently low, and really this is a function of accommodative monetary policy. The Fed's guidance really is you're going to see short-term rates at or near zero until unemployment moves down below 6.5%. You can see from the consensus estimates That is not likely to happen throughout 14. With this accommodative monetary policy, we have seen short-term rates, both one-month LIBOR and SIFMA, the tax-exempt index, stay right near their all-time lows. SIFMA is currently 5 basis points. Interesting, in 12, we saw a lot of new issuance volume dedicated to fixed-rate issuance. Hospitals took advantage of all-time low fixed rates to restructure variable rate instruments and to lock in a low fixed rate of capital. With short-term rates staying persistently low, and we'll talk about our forecast of rising rates both in the intermediate and long part of the yield curve, this could create some opportunity for more issuance on our variable rate basis going forward. Healthcare credit spreads is a big piece of hospitals' borrowing cost, and healthcare credit spreads are the risk premium in basis points over our index in the tax-exempt market, AAA MMD. You can see the history here. We had 2004 to 2007 impossibly tight credit spreads. The market didn't seem to be valuing risk appropriately in our estimation, but that created a good environment for lower rated credits to access capital at costs that were not much higher than higher rated credits. Obviously, the financial crisis hit, the pendulum swung, in our view, way too far the other way, and credit spreads really blew out 2008 all the way through 2011. What we've seen recently is a more normalized credit spread environment that's really consistent with long-term averages. We'll talk about where credit spreads are going. We generally think they're going to be pressured higher as we move into 2014. But we want to make this point. One of the reasons cited for the consolidation trend is cost of capital. And what we're really seeing is cost of capital, while it has gotten more expensive throughout 13, is still reasonable even for low investment grade and non-investment grade borrowers. I think this picture just tells a part of the story, as this is just focused on bonds. We are seeing other structures that perhaps could provide a better cost of capital, particularly for lower rated borrowers, and we'll talk a little bit about those trends as we move forward here. Nothing earth-shattering here, just wanted to give you our sense of credit spreads throughout the yield curve by rating. Again, we think the cost of capital is reasonable by historical standards. Clearly, if you compare it to 2012, certainly not as cost effective as it was then. We would say this, though, more importantly, if you look at where hospital borrowing rates are in the bond market currently, and you look at where they've been over a long-term historical average, still very, very attractive. With the upside rate risk factors that we will talk about, perhaps if you're looking at a new money project or an economic refunding, maybe there's a significant amount of negative arbitrage because in an advance refunding, you need to fund a treasury escrow. You may want to think about moving quicker rather than delaying it to potentially reduce the negative arbitrage, because it is a very volatile interest rate environment, and some savings is better than none. So we've talked a little bit about rates. Wanted to just give you a sense of what healthcare bond issuance looks like for 2013. Based upon rising interest rates, although still below historical long-term averages. Really a continuation of declining inpatient utilization, which is resulting in less bricks and mortar capital investment, and some fairly significant concerns around debt capacity. Issuance in the healthcare sector is down pretty significantly year over year by about 33%. This doesn't probably tell the whole story. There is a fairly active private placement market, both bank and non-bank. We think that's having an impact on healthcare bond issuance. A little hard to get a handle on good statistics in the private placement arena, but clearly the issuance trend is down in 13, and as you'll see in later slides, we forecast a decline in issuance year over year again. This is a segment of the market that used to be dominated by credit enhancement. In 2006, for example, well more than 50% of healthcare bond issues carried some form of credit enhancement, with insurance being the dominant vehicle. Year to date in 2013, you can see that credit enhancement has virtually vanished. This is a market that not only is characterized by a dearth of viable credit enhancement, you have spreads widening, again, clearly not where they were 2008 through 2011, but reasonably wide, no credit enhancement, and then some fairly significant variation among how similarly rated bonds trade. It's clear to us that investors are looking through ratings. They're really doing their homework. So in that environment, in our view, what's really key to successful execution is developing and disseminating your unique credit story. If you're able to do that, you're able to get good execution. Don't want to turn this into a Ziegler commercial. We have a comparison here of two recent BB plus issues, one for a CCRC brought by Ziegler, one for a hospital. Clearly not apples to apples comparison, but they did carry the same rating of BB plus in the case of Ziegler by Fitch, in the case of the hospital by S&P, and you can really see here some pretty substantial variation in pricing. For example, on the long end of the Ziegler deal, you're looking at a 7% yield, which was about 281 basis points over AAA MMD, versus the hospital transaction whose final bond came at a spread of nearly 400 basis points. So clearly there is a substantial variation among how similarly rated healthcare bonds trade. One other trend we saw emerge in 2013 was taxable issuance, and some of the drivers there were taxable rates were not much higher than tax-exempt rates for much of the year. With taxable issuance, you have much greater flexibility. You don't have the constraints on how you can spend the money, no concerns about average life, and you're not restricted with respect to how you invest the proceeds. You also don't need a conduit issuer. What we saw really emerge was very attractive pricing for providers rated A+ and above at very tight spreads to MMD. For example, Mayo Clinic came with a transaction, $300 million taxable execution, final maturity in 2047. That maturity was priced to yield 4% or less than 100 basis points over the corresponding treasury. We saw throughout the year providers that were rated below A+ try to access the taxable market for the same reasons that taxable providers were accessing it. And what we saw there was really credit spreads to treasuries really blow out, in some cases well north of 300 basis points. If you contrast that to spreads to MMD for taxable issuance, tax-exempt issuance, pretty wide. But so we think this product on a go-forward basis, unless the dynamics of the market change, really probably makes more sense for providers rated A+ and above. But in thinking about it, the trend with respect to consolidation really contributed to taxable issuance here. Many providers utilized these structures really to build a war chest for either near-term or long-term acquisition strategy. We also, in 2011, we saw a substantial amount of private placement execution. If you'll recall, back in 2011, the municipal bond market was challenged by some comments that Meredith Whitney made about widespread municipal defaults. In some respects, hospitals were essentially collateral damage. We saw private capital emerging with banks doing direct lending and non-bank private placement providers also who are engaged in the healthcare sector doing a lot of direct lending. And the dynamics back in 11 really were supportive. There really was a comparative price advantage for those products. In 12, on the strength of inflows to funds, to mutual funds in 48 out of 52 weeks, we saw the bond market get comparably attractive. MMD hit its all-time low of 247 in December of 2012. As a result, in 11, Ziegler sourced about two-thirds of the capital it did for hospital clients in the private placement market in 2011. In 2012, Ziegler sourced more than 70% of capital in the bond market. In 13 and going into 14, we're really seeing private placement execution, particularly for low investment grade and non-investment grade borrowers, make a lot of sense versus public bond execution. This is not only an attractive source of capital from a cost perspective, but I think there's also some very important benefits and also some considerations to think about. On the benefit side, very low cost of issuance relative to a public offering. Commonly, no debt service reserve fund is required throughout the rating spectrum for this sort of execution. With respect to strategic flexibility, in some respects more supportive. Bonds typically carry 10 years of call protection. Placements are callable much sooner. So an organization is considering its strategic options, a placement may be beneficial in that regard. The documentation is substantially less. No offering document or Appendix A typically required. And you typically do not have to go through the rating process, although the raters who are rating bond issues of the issuers are going to pay a lot of attention to the documentation of the private placement financing, and rightfully so, as it impacts bond investors' position. One of the issues that we think folks in the market probably don't pay enough attention to is the increased cost provisions that are found in many of these bank placements. We certainly understand where commercial banks are coming from. With all this government regulation out there, they are essentially asking for the ability almost unilaterally to increase rates if in fact their cost of capital or capital charges go up to protect their return. What concerns us at Ziegler is there is in your boilerplate bank documents really not a lot of governors in terms of how far that rate could move up. We do see the risk of a bank enacting yield protection as low probability. The severity is very hard to quantify, and what we commonly find is, in many respects, there's not enough discussion associated with this risk, and in my opinion, that's a little bit scary given what we all dealt with in the auction rate crisis and the meltdown. And this is a pretty important systematic risk and one that needs to be understood by a provider before utilizing these structures, which we think can have a lot of benefit. Where the agencies seem to be more focused is on cure period, and I'm not sure I understand why banks. Bond deals are commonly, if there's an event of default, you typically have a 60-day cure period. In placements, it's typically 30 days. If you have an EOD covenant breach, banks, like bondholders, typically have the ability to cause acceleration in the repayment of debt service. They also, if the transaction is secured by a deed of trust, would have the ability to foreclose on a mortgage. And we talked about sort of credit enhancement, though, in the bond market back in the last decade. The bond insurers were really in a similar position. We try to make this case to the rating agencies that, yes, you have a 60-day cure period, but within 60 days, the bond insurer, who really stands in the shoes of the bond investors with respect to directing remedies, could accelerate or foreclose on a mortgage where one exists. In our view, what that really means is a provider needs to do their homework on their capital partners. They need to understand their financial viability, what their balance sheet looks like, and also their commitment to the healthcare segment. But we do think that if providers understand these provisions in the context of organizational risk and their balance sheet strength, that there is definitely application. Why has private placement financing gotten more attractive recently? We've talked about the outflows in the bond market, obviously 28 straight weeks, putting pressure on the municipal market. If supply hadn't been so anemic, we saw that healthcare issuance was down 33%. We think we'd actually see higher rates in the bond market. Unfortunately, a lot of the weakness in the bond market is driven outside of the healthcare sector. A lot of negative headlines on credit deterioration in Puerto Rico, Harrisburg, Stockton, and what that is causing is redemptions in funds, and the funds are under pressure, and they are demanding higher rates on their investments. If you look at in comparison to the bank market, you don't have those same sort of pressures. Banks and non-banks typically price off a Treasury and LIBOR swap rates, and while we've seen all classes of fixed income rise, they haven't risen as quickly, so that's really driving it. We talked about the outflows. We don't want this to be a Ziegler commercial, but here's a private placement transaction we just executed with 3 capital partners. I see that they're on the phone. I probably should mention them, but I'm selfish, and I want to preserve tax-exempt capacity for our borrowing clients. I think the takeaway here is this transaction, natural fixed rate, produced an all-in cost of capital of 4.1%. That was right on top of an A-plus rated bond issue that carried a lower average life that Ziegler served on as a co-manager. So very attractive cost of capital. I think the healthcare trends are well known to most, but clearly what we're seeing is pressure on bottom lines, and that's really impacting how providers source capital. Roger did a great job of giving us an overview of M&A. Clearly, we see robust volume in the sector. We think that will continue, as we'll talk about. Roger talked about some of the mega deals that got done. One of the important considerations is more hospitals are in a position where they need to employ physicians. That comes at a cost when you bring in hospital doctor P&L onto providers' system financials. You're typically subsidizing those providers. That's putting a lot of pressure on providers, particularly smaller ones, and driving a lot of the M&A volume. Obviously, healthcare reform is a key driver of consolidation. We talked about it being off to a rocky start. One of the thoughts was we were going to see offsets for weaker market basket updates, readmission, and hospital-acquired infection penalties in the form of self-pay really migrating either to Medicaid or better to the exchange product. But the early data suggests that that's not happening, and that's going to put pressure on hospitals' P&L. Changing reimbursement models is something that is clearly a concern and driving M&A activity. I think our view at Ziegler is there are providers just from an absolute size perspective that need to get larger. They need to be able to, they need a larger revenue base really to spread over the fixed cost of information technology upgrades, of employing physicians. We talked about those typically coming at a subsidy. As we move into more risk-based arrangements, you really need a risk pool that's large enough. Some providers clearly don't have a large enough risk pool. We would say, though, while we are seeing a slow migration away from fee-for-service to population-based reimbursement, we do think 5 and even 7 years down the line, this is largely a fee-for-service business. So we advise our clients.
Oh, Mike, I was sorry to jump in. I was noticing that quite a few of your slides are generating some terrific questions.
Sure.
In particular, I just noticed a question in terms of your views on healthcare IT capital and what you're seeing and what we can expect in 2014 in terms of capacity to finance IT.
It's interesting. Obviously, part of the drivers for the need for information technology are government regulation. The old stimulus put in meaningful use dollars, which then turn into meaningful use penalties. So that's obviously a clear consideration. We're also seeing the trend line is a growing percentage of governmental reimbursement. We'll talk about it in a second, but our view is providers that have a dominant market position have leverage with payers either in a fee-for-service or population-based reimbursement arena. They all, generally speaking, are price takers for governmental reimbursement. So clearly, information technology becomes more important because you need to get more efficient for government reimbursed business where you are a price taker. You're going to need to lower your average length of stay in many respects, get more efficient in terms of your labor statistics. Information technology plays an important part of that. One of the issues I think the healthcare finance professionals are struggling with is how do you finance information technology, or do you finance it? These are usually short-lived assets. There could be a mismatch if you go with a longer life financing. If you go with a shorter life financing or you pay out operating cash flow, could put some pretty significant pressure on your balance sheet. Heidi, does that answer the question?
Yeah, I think that does, Mike. We've got a couple other questions that there was another question that Mike that was prompted by your slides, and before we get into the Q&A that we wanted between you three, another listener said that on slide 20 you listed lower rated credits which utilized the debt service reserve fund. Were these fully funded? And from your sample, how many provided a mortgage or other restricted covenant?
It's usually either or. If you don't have a DSR and you're in the BBB category, you are going to require a bond issue. You are going to require a deed of trust if you're a BBB category provider in the current market. I would say that the overwhelming majority of the DSRs were fully funded, but there was some that were either partially funded or part of a pooled reserve.
Okay, terrific. Mike, we need to give, there's a lot of lawyers sitting out in the audience there that have been patiently waiting for their CLE code. Let me give the CLE code to those of you who have to report. Here is the CLE code. It is L as in Larry, H as in Harry, 2, and G as in Gary. So that's LH2G, and you can utilize that in your reporting. Guys, what we'd like to do now, if it's all right with everybody, is we have, Mike, specifically starting with you, we wanted to talk a little bit. We had a few questions that we know that there are folks out there that are probably very interested in knowing your, your view of this, and David and Heidi, yours too. Given the robustness of the activity that we saw in 2013, specifically around hospital M&A, as physician M&A, what kind of affiliation activity is Ziegler and Mike, you specifically, are you looking at in terms of in 2014 and beyond? Do you think this trend is going to continue? And what do you think? What do you see the market doing?
Great. Roger, we do think the consolidation trend will continue, but where we differ, I think, from most is we do see community-based providers being viable in 2014 and beyond. We've mentioned that some providers will need to be consolidated out of business. They lack the size or the market clout in their respective markets. But in our view, what matters more than absolute size is size relative to market. We think providers that have a good market position, have a reasonably good payer mix, whether they be a standalone community hospital, a small regional system, or a large multi-state regional system, will outperform. And with respect to our community-based clients, we encourage them to be proactive, look at strategies in and around your market for consolidation, with you being the consolidator, that can really better position the organization in its contracting with insurance payers and in its relationships with its physicians.
Well, you actually asked you answered what was going to be our next question and my next question, which was what you think about continued independence for community-based and smaller or regional systems. Heidi and David, I think we're going to be. I'm interested in your view of this. My view of this is that we're seeing a lot of smaller independent hospitals struggling because, frankly, a lack of relevance to physicians. It's becoming harder and harder for them to be relevant to doctors who want to participate in ACOs or managed care programs, physicians who want better leverage with payers in terms of contracting and looking for those hospitals to do that, and we see those hospitals struggling. Heidi and David, do you see that? And then Mike, we'd like to hear your follow-up on that too.
Yeah, I'll wade in, and obviously when we're participating in a deal and conducting due diligence, it's always one of the first questions we ask during management interviews. What's your take on consolidation? And we certainly have had conversations with quite a few, what I describe as smaller regional systems that may have absolutely no appetite or interest in affiliating with a much larger system, and that's for a variety of reasons. And one of the things I continue to hear in terms of what's going to make the strategy viable is they're all quick to point out that they are market leaders in each of their different markets. They're not at the number 2 or number 3 positions, in a multi-hospital city, but rather, they are the market leaders, and for that reason alone, they, think that they can continue to attract the physicians, that they can continue to, have strong bargaining and negotiating power. So, I think what Mike was saying and what Ziegler's position is reasonable and certainly is supported by a lot of conversations that I've had with various management personnel.
I'll dive in. Mike and I worked on a deal together this spring for sort of a paradigm of the more community-based hospital that seems to be doing making a good play on having a fairly substantial market share, and they're drilling down on their lines of business, so they're not, they recognize that they're probably not going to get the tertiary patients that are, going to look to a big downtown medical system for intricate brain surgery, but they are looking at lines of business where they can capture a vast majority of the market and looking at building on that. And they've aligned a lot of their physicians around that viewpoint as well, and seem to have, gotten a pretty strong and positive response from that. And that has also led to their being able to they certainly aren't able to name their terms, but they are they are holding their own with the payor sector. So I think, as we've been discussing, a lot of this has to do with having a strong share of the market, understanding what your strengths and weaknesses are, and looking at it. Because on the flip side, we're seeing an awful lot of affiliations, and in Massachusetts here, what I'm really seeing is in large part you see 2 or 3 major systems that are reaching out and trying to come up with some sort of networking kind of arrangement, even if it's not a direct merger or acquisition, so that the outlying community hospitals are feeding their tertiary patients downtown, and the downtown is then using the outlying hospital for primary care, for infusion therapy, things like that, where people don't necessarily need to go downtown. And those are very different business models, and it's going to be interesting to see, how the independents are able to maintain that independence. But the folks that are doing it by really keeping a close eye on what they're good at.
Yeah, just to expand on that, we do have a case study in the transaction that Dave mentioned. It was Lowell General Hospital, and what Lowell did was they acquired their longtime competitor, Saints Medical Center. They went from 40% share to 60% share, so better leverage with their payers. It is a cost-conscious state, so perhaps that leverage isn't what it would be in other states, but what it really did, and part of what's driving a lot of the M&A activity, is it kept a more substantial competitor out of their service area, so it was defensive as much as anything. As a result of that, there was, the competitor was struggling, had a very weak balance sheet, deep below investment grade rating, so there was dilution in the financial profile. But we think long-term additive. The market really agreed with us. Dave and I did collaborate on a bond deal. We were lucky in some respects in that we priced the transaction in mid-April before the Fed comments about QE3 unwind. That was also a function of our client moving very, very quickly in terms of getting the documentation together. In some respects, community hospitals and small systems, they can be more nimble even in capital markets, and what we saw was a very attractive cost of capital as depicted on this final slide. We were able to do this transaction without a DSR. Moody's did downgrade us based on some of the dilution in the financial metrics, but what we did was S&P stayed put at BBB+. We then brought in Fitch, at BBB+, which validated S&P, dropped the Moody's rating, and you can see how we performed versus a similarly rated transaction that came, one day prior.
Mike, you made mention in one of your earlier comments that you think that there are possibly providers in certain markets that aren't going to be in those markets. And maybe I misheard that. Are you guys also forecasting that we're going to see more either defaults on credits, or that we're going to see bankruptcies and or dissolutions of hospitals?
Well, let's just take a look at that. One of the things I think investors and agencies ought to pay a lot of attention to, and the astute investors do, is, while we've seen all this negative news on Puerto Rico, Chapter 9 bankruptcy for Detroit, largest ever, hospitals are performing very, very well. Because of Roger, you talked about private equity, you talked about the mega for-profit deals. What we are seeing, and you saw it here with Lowell General and their acquisition of Saints, is a lot of these distressed entities are getting consolidated up, and the bondholders are getting made whole at 100 cents on the dollar. In the example of Lowell, you could have let that go the competitor perhaps go Chapter 11. Then you're in an absolute food fight for the asset. And so, with the exuberance of both private equity and traditional for-profit dollars, as long as that continues, while we do think hospitals perhaps will struggle a little more in 2014, we think in large measure bondholders will be made whole as they've been. One other thing, just want to mention, healthcare credit versus municipal credit, and I don't think this is widely publicized as it needs to be, is, hospitals could teach munis a real lesson with respect to pensions. Obviously hospitals are struggling with an accumulated pension liability, but basically in large measure, they froze those DB plans several years ago. Many municipalities are frankly in denial about that. Do they need to become, mini Greece before they do that? I think hospitals are ahead of the curve in that respect, and that doesn't get the attention that it deserves.
All right, I think we've got about one more. We've got a couple of minutes for one more of our questions, and I think we've got another question from the audience, and we want to open it up just in case anybody else from the audience has any questions. We see that direct purchases seem to be a pretty attractive financing vehicle in 2013. Do you guys expect that trend to continue?
I'll dive in. I absolutely think that's going to happen. And as we were preparing for this webinar, we were talking about this. Mike has had some direct experience with this, where he's been able to do some direct placements where the cost of capital was significantly less. And I think, as we've been talking about it, the market is in some senses, the public market is looking at the municipal market with is painting it with a broad brush. And, when there's bad news from Detroit or Puerto Rico or Jefferson County, the people will just kind of run away. Whereas I think some of the direct placement purchasers are willing to do that kind of diligence to look carefully at a credit and make a reasoned determination as to what the appropriate return is going to be. And so that inefficiency is driving to some lower rates, notwithstanding that there are some other benefits of direct placements. I think the flip side of that is that there can be some downsides to direct placements in terms of the kinds of covenants that are demanded and some of the other kinds of requirements that may be requested, that it's important for borrowers to understand that they can be finding themselves in an awkward position, especially as it affects their outstanding publicly offered debt.
Yeah, I would absolutely agree with Dave. We think private placement volume will increase compared to hospital volume. Obviously we've talked to death about the pricing comparison. These transactions also support better strategic flexibility, and with the consolidation trend, that's an important consideration. However, we would advise that folks really do their homework on some of these unique provisions and really pay attention to the increased cost provisions if they are considering the structure.
Terrific. Thank you. Thanks, guys. Operator, if we could open up the line, if anybody has any questions over the last 5 minutes, we can take them both there as well as online. We do have a question that did come in. Another question that came in. We've had a number of questions come in, but this one came in a few minutes ago, and the question probably is for David and Heidi. Does a registered municipal advisor have a fiduciary duty to obligated persons?
That's a very good question. Dodd-Frank does not extend the fiduciary duty to obligated persons. It only runs to the municipal entity that is being advised. But Dodd-Frank also basically has a blanket prohibition against any act, practice, or course of business which is inconsistent with rules issued by the MSRB. And one of the things that is going to be interesting is to see whether or not the Municipal Securities Rulemaking Board issues rules that extend the fiduciary duty to obligated persons. It would be going beyond Dodd-Frank, but it's not terribly inconsistent with the kind of general thrust of the requirement.
Thanks, David. We have another question, and I'm sorry, operator, I can't for some reason on my screen. I'm having trouble reading it, and it comes in and says, "What can one do about the increased cost?" And then I can't. I apologize to the questioner. I can't open it up enough to see it.
Roger, I can see
Can you
it.
read that question? Okay, great.
Yeah, it's what can one do about the increased cost provision? And that relates to direct placements. Banks, and I understand their position, are concerned with all the government regulation out there, and so you can perhaps on the margin look to do things like, instead of a short notice period before they can enact it, perhaps get a longer notice period. If you're in a situation where you'd be subject to some prepayment, maybe get a special par call. If the lending bank does enact yield protection, you can make it such that the lending institution cannot increase the interest rate on your transaction if the increase is caused by a bank rating downgrade. But one thing they will not give you, unless there are better negotiators out there than me, is any sort of governor in terms of how much the interest rate could rise, and that's what becomes difficult from our perspective. If somebody would say, if we had a bank placement rate that was 150 and a non-bank rate that was 2%, and you were able to say to the bank lender, well, as long as you give me a governor that if you do enact yield protection, the rate will not go up by any more than 50 basis points, it might be very clear to you in terms of who you should select. But in my experience, we've not been able to sort of put a governor on it. And I just want to reiterate this because I know there are some bank lenders out there. We certainly understand your position. The government regulation makes it very hard for you to extend credit and make sure that you have a return that is acceptable from the organization. So, we did say some positive things about placements. Bonds do have certainty with respect to rates, and so you need to look at not only cost of capital, but also, evaluate financing terms based upon your organization's risk tolerance.
Yeah, Mike,
Yeah, Mike,
I'd echo, Mike, what you just said, and would add two things. I mean, I think that the banks do have some flexibility to negotiate that provision, and to add to the flexibility. I think to the extent a bank invokes an increased cost provision, I have successfully gone in and negotiated for immediate prepayment. Basically, the borrower will have the right to buy itself out of the increased cost provision. The other item that I guess you could say it's a governor, but basically to limit the look-back period, if you will. So so there is flexibility. I guess no provisions jump quickly to mind where we've gotten rid of it. But I think the stronger the credit you are, the more leverage you have to negotiate on this point. And certainly there are ways to negotiate and try and build in a little flexibility in that provision.
I'll jump into a couple of things that we've seen in addition to what you mentioned, Heidi. We've been able to get often able to get a bank to agree that it has to be generally applicable, so that they can't just pick and choose the borrowers that they will charge this increased cost. It's got to be an across the board. But I will note that that at least in a proposed rulemaking put out by the Office of the Comptroller, municipal securities were not treated very favorably under the reserve rules, and that may well have an adverse impact on borrowers as well as folks who have letters of credit provided by banks, because these same provisions show up in your reimbursement agreement, that if the reserve rules require banks to hold substantially greater collateral against the obligations under the letters of credit or against municipal debt, that's likely to drive up their cost and likely to cause them to invoke these clauses. So while these are fairly arcane rules, they have unexpected and perhaps unanticipated negative consequences.
I want to thank all of you guys, David, Heidi, Mike. Thank you very much. I think you did a terrific job today. I know that there are a few more questions in the queue. What I would suggest to those folks who have questions, it looked like one of them probably was a Mike question. You'll be able to email the participants, as well as if we've got any follow-up CLE questions, the folks at Foley will be able to help you with those, but we're respectful of everyone's time. We're past the 1 o'clock mark. We want to thank everybody for sticking around, and many of you stuck it out for the entire hour and a half, and thank you for that. And you can look forward to more Access to Capital webinars from Foley in 2014. Thanks, everybody. It was terrific.
And that does conclude today's conference. We thank you for your participation.